The world's biggest investor, Warren Buffett, just made a whopping sum of $336 billion from stocks. Which stocks did he invest in? How did he manage his investments? What are his investment strategies? This video is a must-watch for all investors aiming to scale up their investments, as we've gathered and compiled the secret to Warren Buffett's $336 billion stock portfolio. Join me as we dive into the investing secrets of world millionaires. Watch to the end, because what you're about to discover will blow your mind. Before we dive into the real thing, you need to understand the dynamics of a stock portfolio. So, what is a stock portfolio, and why is it so important? A portfolio is a toolkit for constructing your financial future. It consists of various financial assets. Many investors like Robert Kiyosaki, Jim Rogers, and even Mark Faber all have stock portfolios with multiple purchased assets. These assets may be well-known securities like bonds and equities, or they may even be cash equivalents. You may customize your portfolio to meet your unique needs, much like you can stock a toolbox with various tools. Now that you know what a stock portfolio is, let's dive into all the secret stocks that earned Warren Buffett over $366 billion. In actual fact, he isn't the only one making such an amount from stocks. Are the rich employing secret strategies that the average investor is unaware of? One of Warren Buffett's secrets is his investment in one of the biggest, if not the biggest, smartphone and gadget companies on the planet: Apple, NASDAQ, AAPL. The renowned investor Warren Buffett's Berkshire Hathaway still has a sizable stake in Apple, even after cutting its ownership by roughly 1% recently. Apple still represents a sizable portion of his portfolio, roughly 44% of all funds invested. Among the strongest capital return plans in Warren Buffett's stock portfolio is Apple. Its 0.5% yield isn't particularly noteworthy, but its nominal distribution of more than $15 billion yearly makes it one of the greatest payouts in the world. In addition, throughout the previous 10 years, the corporation had repurchased $586 billion worth of ordinary stock. When Berkshire's ownership in a firm increases through share buybacks without any effort on the part of the company, Warren Buffett is overjoyed. Of course, with the growing trend in AI, one would be unwise not to invest in any upcoming AI companies ruling the world today. As a smart investor, Buffett understood the importance of venturing into AI stocks. One of the AI stocks on his $336 billion portfolio is Amazon, NASDAQ AMZN. Even though Amazon is most commonly associated with online shopping, its substantial investment in artificial intelligence, AI, is not as well known. Amazon uses AI for far more than just tailored advertisements and product recommendations. At Amazon, there are diverse applications of artificial intelligence technology, one of which is personalized shopping experiences. Amazon's AI algorithms make product recommendations based on user preferences by examining user behavior and shopping patterns. This improves the shopping experience and boosts client happiness and sales simultaneously. Another application is enabling AWS clients. Amazon Web Services, AWS, the business's cloud computing division, gives clients access to the resources and infrastructure they need to use AI. This involves the application of generative AI, a potent subset of AI that enables companies to produce wholly original works of art and software. AWS clients can use generative AI to enhance customer interactions, personalize ads, and gain a competitive advantage. Added to Buffett's portfolio is an investment in a credit card company known as American Express. For Warren Buffett's Berkshire Hathaway, credit card giant American Express, AXP, has been an exception. It has been a fantastic long-term investment since 1993, as seen by Berkshire Hathaway's holding, which has gained an unrealized gain of over 1,700%, not including dividends. But what makes American Express unique and contributes to its success? It is its distinct business style. Unlike standard credit card firms that only serve as transaction processors, American Express cleverly uses two strategies. It serves as a lender as well as a payment processor. In terms of credit card network purchase volume, American Express is the third-ranked payment processor in the US. giving it a commanding market share. With its $8.49 per share cost basis on Amex, Berkshire's $2.40 annual dividend distribution represents a 28% yield above cost. This inclusion adds great value to Warren's portfolio. Of course, Buffett picked an interest in the banking sector to expand his portfolio, and his investment went straight to the Bank of America, NYSE, BAC. With his investment in Bank of America, Warren Buffett made a major strategic wager on the financial industry and its well-known tech assets. The company's holding of almost 13% of BofA's outstanding shares, or a sizable investment valued at over $35.5 billion, indicates this commitment. The faith that Warren Buffett and his investment team have in Bank of America's long-term prospects is demonstrated by this investment. Moreover, Bank of America has continuously proven to navigate economic cycles. With a history of surviving financial crises, the bank is proud of its fortitude. Buffett's value investment approach, which prioritizes long-term holding periods and businesses with the ability to withstand market swings, is ideally aligned with this stability. And Berkshire Hathaway finds Bank of America's dedication to technology innovation another appealing attribute. Bank of America's investments in fintech solutions and digital banking platforms position it to remain competitive in the changing financial sector, which is experiencing a digital transformation. Berkshire Hathaway's considerable interest in Bank of America indicates its trust in its long-term potential to generate continuous growth and profitability. Buffett's investment indicates his faith in the banking industry's cyclical resilience and his confidence in Bank of America's management team's ability to successfully navigate the rapidly evolving economic and technological landscape. Like many other wealthy men, Warren Buffett has large holdings in the oil industry. Occidental Petroleum, OXY, is one of the companies in his portfolio. It accounts for 0.85% of his overall investment. The Federal Energy Regulatory Commission gave them permission in August to purchase up to a massive 50% share in Occidental, should they decide to pursue that option. This important regulatory permission implies that Berkshire Hathaway values Occidental highly. At first glance, the investment thesis for Occidental Petroleum and Berkshire Hathaway's Chevron venture seems to have some parallels. As integrated energy operators, that is, businesses engaged in every facet of the oil and gas industry, from production and refining to marketing and exploration, both corporations stand to gain from increased oil prices. That being said, Occidental differs in two significant ways. The first and most important is that, when expressed as a percentage of net sales, Occidental depends significantly more on its drilling segment than Chevron. This means that Occidental's financial situation will be more significantly impacted. In contrast to Chevron, Occidental's operating cash flow and, consequently, its share price are likely to suffer more dramatic swings if oil prices undergo notable upward or downward fluctuations. To put it another way, Occidental's financial success is more closely correlated with the price of oil. Another oil investment in Warren Buffett's stock portfolio is Chevron CVX. Remember that even though Berkshire Hathaway garnered notice for reducing its Chevron holdings by more than 30 million shares in the first quarter, Chevron is still Berkshire's fifth largest position. This large investment, which is presently estimated to be worth over $20 billion, demonstrates Berkshire's ongoing faith in the massive energy company. The main financial three of Berkshire Hathaway, Ted Weschler, Todd Combs, and Warren Buffett, decided to provide such a large sum of money to an integrated oil and gas business like Chevron, probably because they all believed that the price of energy commodities would continue to rise. Numerous macroeconomic variables appear to corroborate this theory. Globally, persistent hostilities and geopolitical tensions continue to impair energy supplies, unsettling the market. As evidenced by the recent increase in oil prices, this uncertainty can lead to price surges. Worries about possible supply chain disruptions and the prospect of more penalties against significant oil producers further exacerbate the unstable situation. These things suggest that Berkshire Hathaway's acquisition of Chevron was a well-thought-out decision. The current climate of high energy prices presents an opportunity for the corporation to prosper. Chevron is an integrated operator that works on all stages of the oil and gas value chain, from production and refining to marketing and exploration. Their ability to diversify gives them the chance to benefit at different points in the process. Aside from the oil sector, Buffett also included a food company in his portfolio called Kraft Heinz. For Warren Buffett, this popular food company is an attractive investment opportunity due to several reasons. Above all, the corporation has a solid portfolio of well-known brands, including Grey Poupon, Oscar Mayer, Velveeta, Kool-Aid, and Jell-O. These well-known brands are very dear to consumers, frequently conjuring up fond recollections and customs. Because of this brand devotion, Kraft Heinz products are consistently in demand, which generates a steady flow of income. Businesses like Kraft Heinz with a well-known brand usually have a big edge. Customers are more likely to select well-known brands, which results in steady sales growth. For investors looking for steady profits, this steadiness translates into dependable cash flow, a crucial indicator. For Kraft Heinz stockholders, this means a robust 4.1% annual dividend yield. It's interesting to note that Kraft Heinz encountered a somewhat unusual situation during the COVID-19 pandemic. Kraft Heinz benefited while many other companies suffered with lockdowns and changing consumer habits. There was an increase in demand for quick and simple meals and snacks as more individuals stayed at home. The well-stocked pantry basics from Kraft Heinz suited the bill perfectly, flying off grocery store shelves and boosting sales figures for the business. Finally, on the stock portfolio list, Warren Buffett deems it fit to venture into brewery stocks. As a professional investor, it is clear that the most obvious choice is Coca-Cola, whose stock is valued at $23,812,000,000, 6.4% of invested assets. The fundamental ideas that underpin Buffett's investment philosophy are embodied in this long-term holding, which goes beyond simple brand awareness. One of the reasons why Buffett decided to hop on the brewery company is because Coca-Cola has a remarkable history of steady prosperity. It has dominated the global brand landscape for an incredible 10 years, according to Kantar's Brand Footprint Report of 2022. Since Berkshire Hathaway values long-term stability over short-term gains, this steadfast client devotion translates into dependable cash flow and earnings. Coca-Cola has evolved into a masterclass in compounding returns in addition to its steady profits. Because of Coca-Cola's consistent dividend growth, Berkshire Hathaway's original investment, which had a pitiful cost base of $3.2475 per share, is now producing an astounding 60% annual yield. Buffett's conviction in the power of compounding returns, that even small investments can eventually snowball into large wealth, is ideally aligned with this method. One of Coca-Cola's main advantages is that it is a consumer staple product. People will always be looking for necessities when it comes to beverages. Because of its innate resilience, Coca-Cola's cash flow will remain mostly stable even during recessions. Berkshire Hathaway's investment philosophy, which places a high value on businesses that can withstand economic storms, is based on this stability. One cannot stress Coca-Cola's steadfast brand loyalty. The company has raised its base annual dividend payout for over 60 years, demonstrating its commitment to rewarding shareholders. This dedication to creating long-term value aligns with Berkshire Hathaway's shareholder-centric philosophy. Now, to the good part. The secret we have all been waiting for. Apart from accumulating a portfolio of high-value investments, Warren Buffett has mastered the art of value investing by combining stocks that reflect his and his company's interests. While Warren Buffett is not a fan of fundamental analysis, he is meticulous enough to target high-value stocks that can yield and maintain a stance over time. His analysis is clear and precise. His secret is as simple as it can be, only if you understand the basic concept of value investing. What Warren hasn't done is randomly choose companies with a high ROI rate. Rather, Warren has decided to diversify his portfolio with mega players leading various in-demand business industries. Apple, which makes up 44% of its investments, is a big player in the tech world. In banking, the Bank of America sits in a comfortable position, and with a track record of success, it's easy for Warren Buffett to make his own choices. Coca-Cola sits as the second largest beverage company in the world. This is what value investing gets you. So, if you are looking to invest big time and build your portfolio, go ahead and make a careful analysis that will make your investment profitable. Remember, trading accurately takes patience and practice. Thanks for watching this video. See you in the next.